Hello everyone, I'm Ankit and you're watching StudyIQ IAS English. In our today's video, we'll deal with a very important topic of Indian economy. That is, why are prices of goods and services, specifically, why is inflation rising in India right now? Now, the reason why I've picked up this topic for our today's discussion would be very clear once you get the context. Now, what had happened in India that after COVID-19, the prices of goods and services, they were rising, but they were rising at a very moderate levels. So the level of inflation, which is gauged by various indexes like wholesale price index, consumer price index, etc., they have been growing, but at a very moderate level. But something changed at the start of this year. If you look at this graph which tells us the level of wholesale price index, you would realize that from June 2025 up till December 2025, the levels of wholesale price index were either negative or they were close to zero, right? But what has happened since January this year, the wholesale price index is rising, so much so that it has reached to a level of almost 10%. So what are the reasons behind this increase in inflation in India? We are going to understand in our today's video. Now, before we get ahead, please understand the notes which I will be using in our today's session, the annotation that I will be doing it on the board, will be available to you also on the Telegram channel called as ETS Live. So as soon as this video ends, go to this Telegram channel called as ETS Live, where you will get the notes, download them and read them at your own pace. Okay. Now let us start our today's discussion by first understanding how do we calculate inflation in India. Now, calculation of inflation in India depends upon the perspective of many different entities who are engaged in a supply chain of manufacturing a product. These might include the producers of the product, these might include the sellers of the product called as wholesalers, or these might include the perspective of inflation from the point of view of the person or the entity responsible for purchasing the products, that are end consumers. So theoretically, in any well-functioning economy, we calculate inflation at three different point of views. That is at the point of view of a producer, wholesaler and a consumer. Let me give you a very simple example of how inflation actually varies from the perspective of these three different entities. And I've taken an example of an oil producing company of India called as Indian Oil Corporation Limited. So Indian Oil Corporation Limited acts as what? Acts as a producer of petrol and diesel. At the same time, the petrol pumps which are near your house, they act as wholesaler of the petrol and diesel. And on the other hand, people like you and I, we are what? We are consumers of the product that are petrol and diesel. So let us try to understand how inflation actually is calculated. Now suppose you're in Indian Oil. So what are raw materials for you? Raw material would be for you would be the crude oil that you're importing, or the machineries that you have set up in your refinery, or the people that you've employed who work in your refinery in order to produce petrol and diesel, right? So inputs for a producer like Indian Oil would mean the cost that it pays for its raw materials, for its equipments and for its workers. So these are all called as input costs. So let us suppose in 2025, Indian Oil buys crude oil, spends money on its workers and spends money on setting up of its plant, and it is, let us suppose all of that cost adds to 100 rupees in 2025. On that imports, let us suppose crude oil, Indian Oil must also be paying taxes to the government, like the taxes called as customs duty on imports of crude oil. So that tax goes to the government. But all in all, how much is Indian Oil spending just on its raw materials in inputs? That is 100 rupees. Now using that 100 rupees crude oil, using that 100 rupees worth of labor and equipments, Indian Oil is able to produce 200 rupees worth of petrol and diesel. So this is what? This is the output of the producer called as Indian Oil. Now when a wholesaler, that is petrol pump, buys this petrol and diesel from Indian Oil, it also pays taxes to the government like the central excise duty. Right? So from the point of view of the Indian Oil, it is receiving 200 rupees from the wholesalers for its petrol and diesel, and it costed Indian Oil just 100 rupees if you eliminate the taxes. right? But from the point of view of a wholesaler is buying petrol and diesel after paying of taxes worth 215 rupees, right? Similarly, when this petrol and diesel is sold ultimately to the consumer like you and I, we pay taxes like basic excise duty, special excise, additional duty. It cesses like road and infrastructure cess, agri infrastructure cess, then state government levies value added tax on the sale of petrol. So all of this adds to the amount of taxes. So a consumer like you and I, when we are buying petrol from petrol pumps, we pay the price that the petrol pump is charging for the petrol. Now you need to understand, on the 200 rupees petrol that the petrol pump bought it from Indian Oil, it paid taxes to the government. On top of that, it would add its profit margin, transportation cost, and it would sell this petrol or diesel to you for 250 rupees, on the top of which you'd pay 20 rupees taxes. So the amount of money that you paid for petrol and diesel increases to 270 rupees. Right? Now to calculate inflation at the level of producer, we calculate inflation either at input level, called as input PPI, which just takes into account the cost paid by the producers for its input. It does not include the cost that the producer is paying in form of taxes to the government. Similarly, if you have to calculate inflation at the output level, you just take into account the prices that the producer receives from the wholesaler, not taking into account the taxes that the wholesaler is paying. So this price of 200 would tell you output PPI. So you compare input PPI with the amount of inputs that the producer is required to pay in the next year, that is 2026. Similarly, if you take into the price that the producer receives in 2026, it would tell you the inflation at the output level. So you get input PPI and you get output PPI by taking into account what? The cost paid by producers and the cost received by producers. It does not take into account the taxes paid by producers or by the wholesalers. Now let us try to understand how the inflation at the wholesaler level ideally should be calculated. To calculate inflation at the wholesaler level, ideally you should take into account the taxes wholesaler pays at the level which it procures the final product from the consumer or from the producers, right? But in India, up till now, that is in few months before 2026, we were not calculating either input or output PPI. So ideally, taxes should have been included in the calculation of WPI, but in reality, in India, up till now, the taxes are not taken into account while calculating the wholesale price index, right? So that is why right now Indian government has introduced PPI and it has said from 5 years from now we will make the WPI irrelevant, right? So ideally we should take into account the taxes paid by wholesalers to buy the product from producers, but in reality we do not take into account that because we up till now were not calculating PPI. Now the prices at the consumer level would tell you how much inflation is rising in the past few years, and this is gauged by a index called as consumer price index. In consumer price index, we take into account the indirect taxes paid by the consumers, and this is how even in India the CPI is calculated. So in India, up till now we were calculating inflation at the wholesale level, that is through WPI, and at consumer level, that is through consumer price index. Only from now on we have started calculating both inflation at input level and output level from the producer's perspective. Understood? So these were basics of how inflation should be calculated and how it is really calculated in India. Now let us try to understand why is prices at the wholesale level actually are rising. For us to understand that, we need to know how WPI is calculated and what are the factors that go behind it in telling us whether inflation has increased or reduced at the wholesale level. Now you need to understand, recently, like every other major indexes of the government, even the wholesale price index WPI was subjected to revision. Here the base year was updated from 2015-16 to 2022-23, and the amount of goods that are covered into wholesale price index also got an upward revision. Now wholesale price index covers inflation in as many as 957 goods. What you have to understand, inflation in services are not calculated as far as WPI is concerned. In India, as I told you, indirect taxes are not taken into account when calculating wholesale price index. Similarly, the RBI relies on inflation at consumer level for its inflation targeting, and it does not rely upon inflation at the wholesale price level to calculate inflation. Right? So this is what you need to understand about WPI. Now, all these 957 goods which are included in the basket of goods to calculate wholesale price index, these 957 goods are divided into three categories. First category are called as primary articles. What are primary articles? These are articles that are produced just with the help of nature. There is no value addition going into it. So primary articles can be divided into primary food articles and primary non-food articles. Primary food articles include crops, fruits, etc. Non-food articles includes iron ore, other things which are produced directly from the nature, right? The second category is called as manufactured products. In manufactured products, the prices are calculated as far as products which are going through a manufacturing stage. So the price levels of potato would be calculated in the prices of primary articles, but when that potato goes into processing and becomes potato chips, it becomes a manufactured good. Similarly, just like primary articles, there are food manufactured products and there are non-food manufactured products. And the third category of goods are called as fuel and power. Now, naturally, these three set of categories have their different weight. For example, primary articles, they have a weightage of 22.76%. Whereas manufactured products, they have a weightage of 63.13%, and fuel and power have a weightage of 14.11%. If you add weightage of all these three products, you'd get a number of 100. Similarly, in primary articles also, different commodities have different weightage, but these are the three broad categories in which all the goods in WPI are being categorized. Now, from the perspective of understanding how WPI works, you need to understand what a Polish economist called as Michael Kalecki used to say. Now, Michael Kalecki was of the opinion that the prices of primary articles, they are determined by just the factor of demand. Why did Michael Kalecki say that the prices of primary articles are determined by demand? The reason is very simple. Now, if you were a producer of a good, let us suppose you're a producer of a primary article, let us say you're a farmer. If there is an increased demand of your crop, can you immediately supply that crop? The answer is no. You'd have to wait for a whole agricultural cycle to complete in order to supply that particular product which is in high demand, right? So whenever the supply of any primary article reduces, its prices go up. And similarly, whenever the supply of any primary article rises, its prices go down. Because the reason that simply the supply cannot respond to demand immediately. It responds to demand, but with a lag of few months. And this lag would actually determine how the prices increase or decrease in an economy. So suppose right now we are in a cycle of El Nino. In El Nino, the rainfall levels in India would suffer. So when rainfall levels in India would suffer, the supply of agricultural commodities would come down and it would put a upward pressure on prices. So this understands why prices in primary articles actually increase due to supply issues like bad weather. Clear? Now, Michael Kalecki also had an opinion of how prices of manufactured products are determined. Here, Michael Kalecki said that the prices of manufactured products are not subjected to just demand. Rather, they are subjected to cost of production, or they are determined by production prices or cost of production. So why did Michael Kalecki said this? We need to understand this. Now, India for a long period of time suffers from what is called as a negative output gap. Now, what is a negative output gap? Negative output gap is a scenario where actual output of the economy is less than the potential output of an economy. What is a potential output of an economy? Potential output of an economy is that output which the economy would be able to produce in its full capacity. So suppose if a factory is there in the economy which has a capacity to produce 100 units per day, but in actual terms it is just producing 60 units per day, less than its potential, that is called as a negative output gap. When any economy like India is in its negative output gap, any additional demand of extra goods would be immediately supplied by production of that extra goods. So suppose today the demand of goods is 60 units as against the capacity of 100 units. Tomorrow if that demand increases to 80 units, the factory would have no trouble in producing 20 extra units. So the prices of that commodity won't be that much be a hostage to demand as compared to primary articles, because in case of primary articles, the supply responded to demand with a gap. But in manufactured products, as we are in a negative output gap, the prices of commodities immediately respond to the supply of commodities, right? So what is actually making it an important point of cost of production is actually the factors like wages that you pay to your employees, the cost of fuel or power that you use to manufacture a product, or the cost that you pay for procuring primary articles that you use in the production. Now, what has happened in last few months, since February 2026 in particular, there has been a war that is going on in the Middle Eastern region between US and Israel on one hand and Iran on another. So because of the disruption in Strait of Hormuz, which transports as much as 40% of fuel requirements to India, the prices of crude oil has increased. When the prices of crude oil has increased, it has increased prices of petrol and diesel, it has increased prices of natural gas and LPG, all of which are used in different forms in a production cycle. So that is why the cost of fuel and power, this component has increased, which also has a bearing on cost on manufactured products. Similarly, the cost of primary articles, they are increasing because of the fear that because of El Nino, our agricultural production in this year would suffer negatively, right? And this is the reason why cost of manufactured products are increasing. So I told you cost of primary products are increasing because of bad weather condition, because of supply constraint. Cost of fuel and power has increased because of disruption in the Strait of Hormuz and now possibly the disruption in Bab el-Mandab Strait also. And as a result, prices of manufactured products has also increased because these are determined based on cost of production, as cost of production depends on how much wages you are paying, how much fuel and power you are paying, and how much prices you are paying for your primary articles. Right? Now the moot point of our today's discussion, if inflation is going to rise, how can we bring it down? The answer is very simple. For that, you need to first of all decouple the prices of your food products from the vagaries of nature. As you may recall, 55.7% of our gross cropped area, it's irrigated, which means the rest of the area, that is 44.3% of our gross cropped area, it remains rain fed. And the crops like pulses, oilseeds, cotton, which are very important in production processes, they are majorly grown in rain fed areas, and whenever the amount of rainfall is less, it directly has a bearing on less supply of these products, pushing up the prices. So the more area we make it irrigated, the better it is for our agricultural yields even in a bad rainfall year. Second solution that we can achieve is by undertaking more construction of agricultural infrastructure. Here we can increase the storage capacity, we can increase the levels of processing, as well as we can rectify the transportation so that perishable items like fruits and vegetables can be supplied quickly. Less amount of it would go to waste and it would translate into lesser supply disruption. Okay, the third aspect that we can work on is on introducing a counter cyclical indirect tax policy. What is a counter cyclical indirect tax policy? A counter cyclical indirect tax policy means that whenever import prices of any commodity, be it crude oil, pulses, oilseeds, etc., increases, we can reduce the amount of customs duty, or we can decrease the amount of excise duty in order to cool off the prices. And this is what the government actually did when the prices of crude oil increased. And that is why you may realize the prices of petrol and diesel, like everywhere in the world, also increased in India. But the amount of increase was less in India as compared to other parts of the globe. So this is how we can continue with this counter-cyclical indirect tax policy and make it a matter of point that whenever import prices increase, our taxes or indirect taxes would come down, right? So these are the topics that we have dealt with today. Now, why are these topics important? You need to understand the topics like how we calculate inflation at producer level, at wholesale level, at consumer price index. What are the different components of WPI? What are different components of CPI, that is consumer price difference? What is the difference between CPI and WPI? Or for that matter, why has India only this year started calculation of producer price index? All of these are taken in a very great depth in our foundation classes. To take admissions in our foundation classes, where I teach like this for the entire subject of economy and other teachers do their part for their respective subjects, what you can do is take admissions to our P2I foundation batches. In our P2I foundation batches, which are available from 27th of July, you can still take admissions by going to our website, adding the code before making the payment, that is ATS Live, and you'll get all of these benefits at just 11,999. You're not just offered with structured classes, but you get mentorship, you get a dashboard which helps you assess your performance, you're given through a multiple iterations of a very structured process of revision and multiple iterations of test series which are available for both prelims as well as mains. All of these benefits are available at just this prices if you take admissions to her P2I batches. P2I batches, by the way, are also available exclusively in English language. Okay. Now, before we wind up our today's discussion, I'd want you all to solve this 2020 UPSC prelims question. The weightage of food and consumer price index is higher than wholesale price index. This straight away is a right answer. Rest two statements you can solve based on our today's discussion. Do let me know the correct answer of this question in the comment section. And before we wind up, the notes of this particular video would be available on this Telegram channel called as ATS Live. So this is all from my side for today. Please have a very good day. Do also let me know in the videos if you want me to cover these topics like that in the future, just in a way I do it in the class through annotations. Do let me know in the comment section. And this is all from my side. Please have a very good day.